Goldman Sachs tells clients it's eager to short tells clients that are eager to short loans that its tool isn't ready. So when I saw this, my initial thought was just Goldman couldn't line up enough bag holders for the private credit funds that they're trying to short. But Matt, what's your read on this, and how does this relate to kind of some of that American growth that we've been talking about? Why is this not ready yet, and why do you think this is a key kind of headline that came out?
Yep. So what it's talking about here is a total return swap product that Goldman would sell into its clients, right? And our firm Build, we have a counterparty relationships with Goldman Sachs. So it'd be asset managers, hedge funds, could be pensions, et cetera, who would um, either buy or sell or go long or short the return on this basket of leveraged loans. And we'll talk about what those are in a second. Um, and on the other side of their trade, they'll have to pay. That would be the uncertain return, like what happens in terms of total return for this loan portfolio. Um, and then on the other side of that, you would either go long or short a fixed interest rate on the opposite end of the swap, right? So what are these leverage loans? Just to start, they are over-the-counter private loans. What does that mean? It's kind of like bespoke one-on-one um, bank or regulated financial intermediary originated or underwritten um, debt that doesn't trade on your typical broker dealer liquidity exchanges. So what do I mean by that? Or venues. Let's just not say exchange. It could be just a venue, right?
Right.
Um, so let's say we're looking at the investment grade debt market or high yield debt market. Those are supported by a network of broker dealers who provide liquidity. They internally report up through like the trace and architecture for price, clearing, settlement. So um, there's observability, across the market on what's going on with liquidity, price discovery, all of that. Versus the opposite end of that would be an over-the-counter market where price and trading is opaque. We don't quite know, uh, who is trading. It's not necessarily reported. Um, so by definition, this leveraged loan market is more difficult to structure. This total return swap product that Goldman Sachs has been kind of marketing to its clients who wanted to short. We talked about the story, in the prior weeks, February. This is the big story, and credit markets. The kind of the creative destruction of software loans in the private credit space and the leverage loan market space. That AI was really, uh, the narrative was AI was eating its lunch,
Right.
right? Um, so part of the reason why this total return swap on leverage loans is difficult to structure. No borrowing market exists, right? You can't go and buy and short these shares like with your broker dealer counterparty, like you could for like an exchange traded stock or even say a, a more like a trace eligible QSIPT debt offering, like you could. There's also like talked about the pricing opacity, but there's a settlement lag. It's actually something on. It's not T+2 settlement like you can do for sorry, T+1 now. We shortened a day in the last 2 years on trace eligible bonds, right? These loans, just because of the counterparty uniqueness. They're over the counter, they trade off exchange, all of that. You've got longer settlement times, so they're T+10 all the way to T+20 plus. Like they just the whole process takes longer. Um, and then that makes the daily mark to market for these total return swap termination and margin calculations. Uh, I would say like more contentious. You can argue over them more because you don't quite have these market reference rates or like a true oracle to look at
Right.
and set price on these swaps. So it makes it more difficult to fix and nail down, which if you're thinking about it from the standpoint of a counterparty or a hedge fund looking to go long against this instrument with Goldman as your counterparty, uh, there's a lot more fudging that can go on, um, which makes this, a more, I guess you'd say, just a more a product that is geared towards more of an affluent or what would you call it, just an educated,
Larger
a
institutional.
high
Yeah.
end institutional audience or product for this market. There's also no standardization for like the reference rate. So the indices themselves for leverage loans, they don't fully have that built out yet. And there's some wrinkles there too, where we talked about all these loans, the liquidity profile for each of them may be different. The ones that actually trade are by definition going to be the most liquid. So it makes it hard when you don't have quotations and dealers axed on say a lot of these loans that might be at the bottom of the barrel, but they make up a decently large kind of cross section of this market. Um, and yeah, Bloomberg noted that, like, just arising from that, you get into the liquidity paradox. It's the most liquid loans that get hit the hardest, not the riskiest. And when you're thinking about pricing, right, you got to price at fair value. If someone is selling into a forced liquidity fire sale, right, it makes it hard to determine where do you mark these things on a day-to-day basis. Um, because if the index itself marks or it like fixes based on the fire sale price based on the most squeezed longs on say a levered loan, if you price the whole thing at that, it's just going to force
Right. It just.
everybody, drag them down into the hole
Right.
with them. So there's a lot of kind of intricacies here in this illiquid uh, OTC market to build around, and Goldman just isn't ready for it yet. So I didn't really talk about this up front, but how does this work, right? How does this whole complex work? Just the assembly line is pretty straightforward. Financial institutions create these loans. They'll underwrite them, create the credit, et cetera. And then what they're looking to do is actually sell that loan to a new like ultimate balance sheet who will be the long-term owner, and that's where the CLOs come in, right? So the collateralized loan obligation, CLO funds, they're the ultimate buyers here, and then they'll sell, to map those assets ultimately to the final beneficial owner, which is, it's looking to be pensions, insurance companies, et cetera, other long-term holders of the debt. Um, and what you see when the market, Cameron, if you go to slide 9 here, when the market starts to, if there's a problem in that kind of assembly line of the production process as the sausage gets made for these small and middle market, you know, uh, credit creation that takes place, what you would generally see is the buildup on the balance sheet of the originators and underwriters who, they'll fund the loan to create it, but then really what they're trying to do is just be a middleman and pass it off to the buy side, if you will, which is the asset managers, hedge funds, et cetera, who go long those leveraged loans via the CLO containers, right? My point here, how would we know if this whole little market is becoming a problem? One of the things you would look for to signal that there's a bottleneck on the assembly line, um, the insurance companies, the pensions, et cetera, those final buyers um, who sit on the asset, they would show some sort of capacity constraint. They would stop buying. Um, and that's where you would expect to see the inventory of trading assets or assets held for trading to start building up within the what do you call it? The non-shadow banking, like the regulated banking players, who are the ones doing the credit creation at this point. And this series here is from the H.8 report. We talk about this a lot. It's the weekly survey that the Fed does on the commercial banking system's balance sheet within the regulated, domestic U.S. Financial system or commercial banks. And the first call out here, go back to the window 2001 to 2007, where the growth kind of engine that the credit creation was going into was household real estate, and specifically we mean subprime. Um, this fool's gold invention. Hey, if we pool this, a bunch of subprime borrowers and we securitize it, chop up the risk, we can create a bunch of AAA assets, and growth growth will
Magically happen.
magically drop
Yeah.
out of this. Yeah, we found out that was all BS. Didn't work. And one of the key things, like when you knew the problem was arising, well, after like the early players, the Michael Burrys, all of that, they would have went long the equivalent of like what Goldman Sachs is talking about here, this total return swap on leverage loans. They went long the CDS market for the, let's say, the AAA or the senior tranches, or mezzanine tranches, those the upper capital stack of the subprime real estate kind of sausage factory. And ultimately, when we knew it was going off the rails, was mid 2007. Once we knew the music stopped, as Chuck Prince, CEO of Citigroup at the time, would have said, the signal would have been the buildup of, just call it these assets or just the loans, the sausage just getting bottled up at the production plant, because there's ultimately no one willing to buy anymore. Keep saying the sausage anymore. So that's when you know the music is up. And my point here, you look at the trading assets so far, it's still following that linear growth path. And I would say for everybody who keeps talking about this private credit issue or leverage loans issue, it's not going to be exactly the same as 2008, in my opinion. Root cause of why these loans are commercial. It's commercial lending to small and mid market that the U.S. banking system doesn't want to lend into um, by itself, right? So if you think about the banking system, what they do is they are the ultimate creators of expansion in the money supply, right? And when they create a loan, literally print money that the private sector uses, they hold about call it 8 to 10 cents of equity behind each loan. If these credits go bad, you're lending into risk in the commercial markets, right? You're lending to entrepreneurs who are satisfying new demands, building new products, uh, uh, spinning up a supplier to build widgets for the Artemis mission series, right? It's risky. Um, but what you're doing here with private credit, or leverage lending, et cetera, you're doing it as the commercial banking system at a, let's say, 2 to 1 leverage. So you've got the upper or the senior 50 cents on every dollar worth of credit exposure, but there's someone else's 50 cents of equity behind it, to backstop your commercial banking system from potential losses and balance sheet contraction. That will ultimately, like, that's the ultimate Achilles heel of any fractional reserve banking um,
Right.
framework, right? So I think what you're seeing here with the Goldman issue that sprung up, because they were saying as recently as March 9th, hey, we're going to get you a product to allow you to short these. Everybody wanted to short the things like the software private loans that sprung up. You're seeing it in the gating of funds like Blue Owl, et cetera. We could pull those headlines up too, but I think I saw something, they got redemption requests for up to, I want to say like
Yeah.
40%, and another fund got like
20%.
20% of capital requested. What this is in my mind, this is a rush for liquidity. It has not so far tipped over into a credit risk or impairment is what this signals to me. Could become that if Artemis had blew up, these products, these growth projects that the U.S. is engaged in, including AI, data centers, et cetera. If these are non-productive or they turn out to be non-productive, it will go, but or it will go that route, potentially turn sideways. But at this point, we don't know for sure. Um, it's a tug of war between um, the bulls and the bears, as they say. Um, but I guess I would say this: we're not Malthusians. We're pro growth, and I'd say it's always dangerous to bet against humanity to figure these things out. All right. And so the last thing on this front, we're talking about like why is this a liquidity squeeze and not a credit event so far? We got another signal of that this morning or Thursday with the 10-year JGB auction, which recorded the largest tail we've seen at 36 cent. I'll go into what that means and translate it. Largest tail since April or August of 2024, which was, if you remember this point where the yen carry trade just hit the headlines. This was where everybody, stayed at a Holiday Inn Express and became an expert on the yen carry trade, as all the social media accounts will pop up to tell you whenever something happens. Right, there's no shortage of experts. But what this means, just quick, the JGB market, they report their tail in terms of bond price. And sen, I didn't know this, but sen is like is to the yen as the penny is to the dollar. So it's one per hundred, or a hundred sen is 1 yen, right? So they record this in terms of price slippage on the auction, whereas U.S. auctions, we would report this as a tail in terms of basis points. Um, and a 36 sen tail roughly equates to a 4 basis points thereabouts tail on the 10-year auction, which is big, right? It tells you there's liquidity pressures like balance sheet constraints within the financial complex. So generally, what we saw in this in April was risk assets and FX liquidity pressures. We just saw this. It's April 2nd. Um, if past is prologue, what this means is more pressure on the sell side, I would say, or towards better selling on risk assets. And just to go in, if everybody remembers, August of 2024. Um, I circled it in red here on the chart. This is the triple Q's weekly 3-year chart. Um, Everybody was losing their minds as, hey, the yen carry trade is exploding. In hindsight, it looks, okay, that's just a stock chart, guys. Don't lose your minds over it. And it was nothing close to the divot that liberation was, um, that followed in about 9 months from there. But I would say be prepared for market volatility. If this JGB yen tail looks anything like it did in August of 2024, and I think if you're looking for a just a headline or something to attach to, like what's it called, like the goldfish memory, right? To Finding Nemo, where the other fish's name who just couldn't remember anything. It's
Yeah.
always the shiny object right in front of your eyes. Don't be surprised if whatever happens with whatever this 10-year JGB auction week result is telling you is coming in the next month, or 4 to 6 weeks, that type of time frame. Don't be surprised if that shiny object uh, gives the distraction. Hey, look over here, and everybody, it gives you, or it gives this administration just that window to take attention off of the Persian Gulf, Iran, etc. Win that battle, move on to the next thing. Uh, don't be surprised. Just in my kind of framework of what you should expect around the corner. This volatility, this episode, we'll we'll re-sticker the narrative and move on to the next thing.